Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast number 74, podcast 64 for the week ending March 19th, 2021. We're going to kick off with some media spots, and then we'll move right into the brass tacks for this week. We've got a lot of great stuff to cover. So first, I'd like to thank Liz Klayman and Ellie Terrett for having me on the Klayman Countdown on Fox Business on Tuesday. And there was a big article out all over from Ray Dalio, who is the founder of Bridgewater, largest hedge fund in the world. And his view was that bonds are stupid to own now, were his words, because obviously they're at near record low yields around the world. And his message was to buy stuff, as you can see in the headline that the producers put there under the segment. And Liz was asking my general view, and, one, do you agree? And two, what stuff are you buying? And the point that I made was, of course, I agree with Mr. Dalio that bonds make a lot less sense to own than equities at near historic low yields. But generally, equities make a lot more sense to own than bonds, period. If you look over 200 years of history, the outperformance is dramatic. It's something like 4 to 5% compounded per year over the last 200 years, the outperformance of equities over bonds. So it is material, and but certainly it's more pronounced now. The point that I'm going to get to in this podcast videocast, though, is the timing of these type of calls to get out of bonds after bonds have already collapsed 25%. Tactically, it may not be the best time to be thinking that way. I think on a cyclical basis, looking over years, certainly the call is correct. But I urge caution that when you have marquee names out with these big calls after huge moves, it's not always the best time to take immediate action. Although the theme is correct for the long term, I think in the short term, it may be the exact wrong time to be getting out of bonds if you are in them. And we'll talk a little bit about why. But however, his point was that while he thinks bonds are stupid, he likes Chinese equities in particular. And I said that I certainly agree with equities over bonds. My preference is in certain pockets of the U.S. stock market over China. And the reason being is we have much better demographics than China. China had a one-child policy from 1979 to 2015. They have an older population. And I think moving forward in coming years, they're going to start to look a lot like Japan looked in the 90s and the early 2000s than how the U.S. is going to look. And that's in particular because our millennial population, 25 to 40, average age right around 30, starting housing formation, is now bigger than the baby boomers. The numbers vary if you look at the different statistics, but the most recent ones I look at said millennials are 72 million versus baby boomers are 71 million. For those of you who are around, if you recall, the baby boomers drove 100% of the growth for over a decade and a half. So in the early 80s, they were at the same age, that 71 million group of people were at the same age as now the millennials are, starting housing formation, and that drove massive growth from the early 80s, early mid-80s, all the way to 2000, when that housing formation, family formation, spending wave kind of culminated effectively in 2000, and that's why we had effectively a decade and a half of sideways growth. I mean, we didn't make new highs until 2013, years after the peak, and that was a function of my generation, Generation X, being substantially smaller, 60, 65 million. We didn't have the same kind of spending power, housing formation, etc., and that's why you had a plateau in growth. Very similar to the 70s we've just gone through. Now we're in the 80s, which is the equivalent of today, the Roaring 20s. And there was a similar demographic setup in the U.S. in the 20s, believe it or not. They had a lot of people at housing formation age going into the Roaring '20s, which drove that growth period as well. So we have a lot of positive structural things ahead of us. I don't believe China has the same setup population wise and demographic wise, and that's why we prefer certain pockets of U.S. equities. And then the flip side as well, we've done a lot more stimulus than China, over 2.8 trillion this year alone. They're already pulling back on their stimulus. Not only did they not do nearly as much on a percentage of GDP basis to combat the pandemic slowdown, but that which they did do, they've already started pulling back. So by the end of the year, they're going to face tightening headwinds in their economy while we're just facing liftoff. And that could be a very positive thing. So, and the areas of growth that you will see in China and parts of Asia, most S&P companies are multinational, and they will be the beneficiary of that. And if you're making a case, which Dalio does, that the dollar is going to be dramatically weaker, which is a reasonable position to take, that will help U.S. companies' earnings effectively, offshore earnings as they repatriate. So I like U.S. companies for a ton of reasons, and in particular, I like. We're going to be talking a lot about today. Right now, what I like. Last year, we were pounding the table on banks, energy, defense, and aerospace. We are holds on those. We own a ton of them from a lot lower bases. But now, where we've been putting a lot of money to work, the first week of this, we started talking about it the last week of February and the first week of March. We put a ton of money to work in utilities, consumer staples, and big pharma. On any weakness in the last 2 weeks, we have added, and they've had huge moves, many of them, particularly utilities and staples, and now pharma is starting to get a bit as well. The other point that was important, because Dalio made an important case against the weakening dollar, if you look back since 1926, the best inflation hedge has not been gold. Believe it or not, it's actually been healthcare. The healthcare sector and healthcare stocks, because demand continues to increase and it's unaffected by pricing power. And, if you understand the pharmaceutical business, it's easy to have pricing power when you have a patent. So, and demand is strong. And that's effectively what's happening. We also emphasized to Liz that we liked healthcare because if you look at the S&P 500, is trading at 22 times earnings right now. And relative to big pharma is trading on average at 13 times. So you're getting nice growth, and the stocks that we talked about, Pfizer, Novartis, and Merck, are all yielding double the 10-year Treasury at 3.5% for Merck, 3.8% for Novartis, and 4.5% for Pfizer. And they increase their dividends. So you have an inflation hedge, you have growth, you have a bargain at the multiple, you have demand increasing, and all the benefits that go into that. We talked a bit on the segment about 5-year inflation break-evens and Operation Twist and rates. We're going to get into that in detail in this call, so I won't spend a lot of time on that here. But just know the takeaway is our focus is in high-yielding stocks right now. High-yielding, particularly focused on utilities, consumer staples, and big pharma. So that's that moving forward. These are the articles. This was Investing in Bonds Has Become Stupid, Ray Dalio says. Here's what he recommends instead, and he talks about Asian equities, particularly China. But again, after a 25% correction in bonds, I think it's the wrong time to be dumping out after a crash. Maybe you want to lighten up on the next rebound. And, starting to add equities after they're up 81% off the lows in, just less than a year. It's not the time to get aggressively long stocks broadly. Certainly China's had a run also off the bottom, and aggressively short bonds when both of those trades are excessively crowded. So it's selectively long equities, in my view, from these levels where there's opportunity, And then bonds, if you want to lighten up, I would wait for the next big bounce, which I think may be imminent in coming weeks. So, but from a secular point of view, I certainly understand where he's coming from, and I think that's the case. And, a guy who's running, over $100 billion, he's not going to be tactical looking at 3-month trades. He's going to probably be looking at 3-year and 5-year trades as he moves that size of money around. And from that standpoint, that's correct. But many people see quotes and headlines like that, and they make the wrong move at the wrong time, and it can be bad from a tactical point of view. Okay, here's the Wall Street Journal article. China becomes the first major economy to start withdrawing pandemic stimulus funds. This was the point that I made with Liz. This article came out, I think, the next day, but nonetheless, they're tightening, we're loosening. It gives us an advantage for the next 24 months. And then this morning, I want to thank Shashank Nair and Meta Singh for including me in their article on Reuters. And it was basically, the 10-year yield. Obviously, it's been going up, but it slowed its pace. It went up from 100 to 155 basis points in basically 4 weeks in February. And now it's gone from whatever it was, 156 to 170 in the next 4 weeks. So the rate of change is slowing. It started to come in a little bit today. And my point was the market's starting to sniff out that the rate of change in longer-ended treasuries is overdone, and we're going to start to see a stabilization of rates, which is going to be good for groups that are yield sensitive. And what I emphasized, which wasn't in this quote, was utilities, staples, and big pharma. And also certain pockets of tech might start to see a bounce, although we're not playing that aggressively because there are other crosswinds in that sector that make me less confident and comfortable in getting overly aggressive. Certainly you'll have exposure to tech if you have exposure to the indices, which you should and probably do. But surgically targeting those, you have to be very careful for the right pockets. Quote of the day from Buffett. I thought it was a good theme for this week's podcast VideoCast. Success in investing doesn't correlate with IQ once you're above the level of 125. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble investing. So what are those urges? Is, puking out all of your bonds after a 25% correction, or buying a ton of equities after the market's rallied to 81% off the lows, just wholesale buying. That doesn't make sense. So I think on both, you just need to be more tactical, more thoughtful, show more restraint, wait for pullbacks, wait for pullbacks to add or buy, wait for rallies to lighten up or sell. And on a tactical basis, that's that, number one. And then number two, I think back to the crash last year. And I was on Fox Business with Liz. It was late March or early April, and Wells Fargo was down 55%. I said, Liz, do you think Wells Fargo is going to do 55% less loan volume next year than they did last year? And she said, that's crazy. And I said, well, Wall Street's the only place you can go where they hold a clearance sale and no one shows up. And that's the type of situation where we're all susceptible to that, in periods of emotion, is, puking when we should be buying. And that's the difference between where fortunes are made and fortunes are lost. So look for those areas that are out of favor. Why are they sometimes things are out of favor because they should be out of favor. But most often it's the short-term voting machine versus the long-term weighing machine. And that's what we try to look at on a weekly basis here is, why is the market manic in the short term and how to take advantage of that? Because in the long term, ultimately the weight of the fundamentals for a particular stock or sector will outweigh and make meaningful money in the intermediate term, 6 to 9 months, if not 1 to 3 years plus. And we're going to talk about some of those groups. Couple highlights here. Nice to see yesterday, 1.4 million people traveled through the TSA. That's relative to 2.3 million last year. So these numbers are really creeping up. We've been over 1 million almost every day for the last couple of weeks. People want to get back out there. Vaccinations are happening. Miles Udland put out over at Yahoo, put out a nice summary of the Ajay Singh Kapoor's bullish note from Bank of America yesterday. And he basically said 3 factors are supporting the market now that should trump any worry du jour that spooks investors, namely liquidity, earnings growth, and breadth. Said another way, money is available, corporate fundamentals are improving, and more companies are doing better. That's certainly Captain Obvious. The question is, what percentage of that is priced in? And that's the real question now, with the market up 81%. And that's why we are focused on those areas that are lag behind and not chasing the things that have already run. And you have to be very surgical in this type of environment. Now, when you have a wholesale crash of a stock market like we had last year when we were buying hand over fist, you could effectively just throw darts at a board and buy almost anything, and it doubled. So March and April, that's twice in a generation opportunity. But on a quarterly basis, new opportunities surface, and that's where we went aggressively early this month. And those groups are really starting to work hard right now. So that's very positive. And they show this nice chart up 77% since the lows on March 23rd. And they just show all the different headline worries. And you can pull this up on the YouTube video, the VideoCast, and you can just see all the headlines and what you were thinking at each point. Vaccine rollout would be a nightmare. They were right. New York Times, December 23rd. Now we have 100 million people vaccinated. Inflation fear lurks, and it just shows these, bumps in the road, and there will always be headlines. But how he concludes is that when free liquidity tightens, when the EPS growth cycle is enfeebled, and when the tape breaks down, we'll worry. Until that time, stay bullish. But cyclicals value and starting to take a fresh look at tech, already bruised by rising bond yield concerns. I'm getting short-term concerned about everyone. Last year we were the lonely man in the woods pounding the table on energy and banks and defense stocks. And now everyone's talking energy and banks, and they're euphoric over it. I certainly believe it's got a lot more to go over the next 1 to 3 years. My sense is, with all this late hot money coming in, they have to take the stuffing out of the Johnny-come-latelys, and that'll probably be in the next couple of months, where they'll rip their faces off. The new money that's buying up 80%, up 100%, they'll rip their faces off, take it back down 10 to 15%, and then if it goes down far enough, we'll add more. But generally, we're a hold, and we're going to just be a hold. We bought a ton last year, so if we got maybe 20%, we would add more. I don't think we're going to get that. But if we do, in some of the energy names, it'll definitely be a possibility, and we will take advantage of it. But we own the stuff from such lower bases that it probably doesn't make a lot of sense to increase our basis on a lot of these. So we're going to focus on what's actionable today. This is a chart of Apple. We've talked about that since they reported perfect earnings. And this stock continues to look broken to me. Now, if I'm correct that yields stabilize in the coming weeks, certainly the rate of change has slowed dramatically, so that's been correct. It had a bit of a knee-jerk reaction to Chair Powell this week, but it always does. The market will digest it. The thing that I shared with the reporter who called me today from Reuters is that people think that if Powell starts to buy the long end of the curve versus the short end of the curve, that's hawkish. And they're confusing it effectively with starting to taper back on buying bonds. Right now he's buying $120 billion a month of $80 billion of treasuries, $40 billion of mortgage-backed securities. To taper back on that and take it down to $100 billion or $80 billion or $60 billion or zero per month, that is hawkish. What part of the curve that he spends that $80 billion of treasury money on is discretionary? Right now it's on the short end. He's steepened the hell out of the curve, which has been great for the banks. It's going to continue to be great. So he doesn't want to flatten the curve too quickly, but He's also got to be mindful that he doesn't lose control of the long end of the curve. So it's a balancing act. And my sense is, if we were to see more episodes like we saw, right after his Fed meeting this week, where you get a spike up and tech is crashing, etc., my sense is they will start to jawbone. Operation Twist, which is the same thing that happened in April. In April of 2011, they started to jawbone it. Bonds rallied off the jawboning, yields plummeted, and they didn't actually implement what they were jawboning until September 21st, after yields collapsed and bonds rallied. And that was actually the top for bonds and the bottom of yields was when they implemented the program versus when they announced the program. So if you get what Powell has been saying is he's data dependent as it relates to that. If you get any whiff of inflation data in coming weeks, the market is going to sniff out that they will be forced to step in. And if they don't proactively do it, they'll reactively do it from the quote unquote bond vigilantes will force their hands. So I'm less worried about rates in the short term. I think we're going to see members come out in coming weeks, or the market's just going to start to discount it, and we're going to have stabilization at these levels. Now, that should favor, it certainly without a question will favor the high yielders, utilities, big pharma, and staples. The question is, what pockets of tech will it favor? And I think there are aspects of FANG that will be beneficiaries. I'm not certain that Apple's going to be one of them. A $2 trillion company, yes, they have the upgrade cycle, but don't forget, they had a dramatic re-rating and multiple expansion in the 12 to 16 months going into the 5G announcement or the 5G launch. They had a multiple expansion, I think in the neighborhood of 50% increase in the multiple, give or take. And so, sans a new catalyst, which the only thing big enough to move the needle is cars, which their talks with Hyundai broke down. So they're going to have to figure something else out, maybe build it internally. But, the head of Toyota said, good luck with that. You better have a 40-year plan. And he's absolutely right. And also confirmed by Elon Musk saying there's only two American automakers that haven't gone bankrupt. That's Ford and Tesla. All the rest have. So I don't see the catalyst for Apple. I think, honestly, the best thing that could happen to Apple is as it continues to drift down. It gets to a very low multiple, and then in the summer they make some big car announcement, or the 5G numbers come in better than expected, and the thing just rips again, takes another leg higher. And that's kind of how Apple's behaved over the long term. So, while if I'm right about rate stabilization, parts of tech should get a bid, maybe parts of FANG, but I have lower conviction than I do about utilities, staples, and big pharma. Those are clear to me because you get the dividend yield, you get the growth. These, on balance, they're trading at 30, 33 times, FANG, etc. 33 times forward earnings with 18% next year earnings growth relative to the S&P 500 trading at 22 times earnings with 25 or 25% earnings growth. So you get more earnings growth of the S&P 500 for less multiple versus tech, where you're going to get lower growth this year because remember they pulled forward a ton of growth last year because everyone was at home. They're coming up on very tough comps in Q1 and Q2 earnings for this year. So I don't see the clear catalyst as I do with the other ones that will benefit from a leveling off of yields moving forward. So that's the 2 cents there. Then you've got, here we go, the Amazon unionization vote, what to know. I mean, look, this is a company that is very progressive. They should be embracing the unionization of their company, I thought. They have the Washington Post. They're all for this type of situation. So I don't see what the problem is. Why do they even have to have a vote? Why don't they just, let them all unionize and double their salaries and double their benefits? I mean, makes sense to me. So a little sarcasm there, but it's it's ironic. I mean, there's great irony in seeing this, and I candidly, I hope their workers are successful on this particular front, because you got to walk your talk. If that's going to be your guiding philosophy, you got to live it and extend it, at home. Okay, acting FTC chair calls for bold action to rein in tech and other monopolies. I would not mess with this person. She looks like she means business. And it's just, again, what we started talking about last August when FANG topped and leveled out has continued. And the drumbeat's getting louder domestically and internationally. And they are honing in on big tech. And I'm sure we're going to see continued movement there. So this was basically what I said. You saw this move from 100 basis points to 155 basis points in 4 or 5 weeks. And yeah, we did get a little spike up after the Fed meeting. But, basically we've been much lower rate, 55 basis points in 4 or 5 weeks, and then, 15, 20 basis points in the next 4 weeks. So that rate of change is changing, and I think we're probably going to level off here. And that's just based on data. So we got the commitments of traders report out this week. And what you saw was that the institutional money increased their longs. They're 2-to-1 long to short, and then the leverage funds and hedge funds, they've been obviously chasing the short. That's already a dramatically crowded trade. I'm surprised short treasuries was not one of the most crowded trades in the Bank of America fund manager survey this week, but it certainly is. Everyone and their mother's short, and usually when you get everyone on one side of the boat, either the both capsizes or you get a reversion to the mean. And I think we're going to get a reversion here, and it's an opportunity to play those groups. Now, these numbers are probably confusing to you, so I like pictures. And here is the green line. These are the commercials that we were talking about. They're always right. They're often early. They buy ahead, and at these peaks, like we have here, it's usually when bonds bottom and you get a rally. Bonds bottom, 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 you get a rally. So they've been buyers. That's the smart money. The dumb money, which is the hedge funds, when it comes to these extremes, meaning they always chase the trend at the end, at the late, after you've had a 25% correction, that's when everyone gets short, and it's often the wrong time. So this is both starting to reverse, and I think we're going to see some stabilization. It's not to say we can't go another 5 or 10% lower. It's not out of the question. There are a lot of reasons, inflation, etc. But I think the juice is out of that trade, and the more likely probability in the next few months is flattening, and if not, a rise in bonds. And that's all you need for these groups to start to take off. This is just another visual, little longer term. You can see this is a peak. That's the bottom in bonds. Peak, bottom in bonds. Peak. The green line. The green is the peak of commercial buying. The bottom in bonds. Peak, bottom in bonds. Then you get a rally. Peak, bottom in bonds, rally. All the way back. I mean, this is back. Peak of buying, bottom in bonds, rally. Bottom in bonds, rally. There you go. Moving on. This is from Macro Charts at Twitter. He has something that's also looking at this. He put this out, I think, today. This morning. And he says bond sentiment is extremely oversold, where major bottoms are formed. So his is a sentiment chart. It's called daily sentiment. I don't know what that's a measure of, but I actually don't really care, because I can see when it gets to this level of extreme that you usually get a bounce in bonds. And that's all I'm interested in. Does it work? Some people spend all their time studying the roots of the tree. I like to pick the fruit. And as you can see, pretty much every time that the sentiment got this low, you got a rebound in bonds. And it's not dissimilar to the extreme of hedge funds being short bonds. That's usually a reversal. Commercials being extra long, they're the smart money. And they're the ones I follow. So particularly on treasuries, it varies from commodity and futures contract to futures contract, but in this one in particular, it makes perfect sense. Okay, now this bullish percent is, again, not really interested in the roots, more interested in the fruit. But in a nutshell, it's those percentage of stocks on a point and figure buy signal. I don't use point and figure charts, but as an aggregate, it's kind of interesting and it's kind of helpful just to help you eyeball with a crayon, not with a scalpel, where things are at extremes. And, we started hammering utilities, staples, and big pharma at the beginning of this month, late last month. You can look back at our articles on hedgefundtips.com. By the way, click on terms. This is not financial advice. This is my opinion only. You should talk to your financial advisor. I only deal with accredited investors for managed money and qualified institutions. So, our strategies are a little bit more sophisticated than what a person should be doing individually. So, take that for what it's worth. And but here's where you find all the articles we've ever written. You can just click on commentary or click on sentiment, and you'll see all of our weekly articles. You can click here under categories for the weekly videocast or the weekly podcast and listen to any back things. You could actually go back a year ago and listen to the podcast and see what we said and what happened. And you probably find that a useful exercise. Okay, so utilities got oversold. Now they're moving up. They're not at an extreme. And this has historically been a good area to buy utilities when they get this overdone and the bullish percent gets that low. It's generally a good area to get exposure. So let's take a look at some of these charts. And if you're on the podcast, you can listen. It's perfectly fine. You may want to take a look at the videocast on hedgefundtips.com just to see some of these, because we're going to be looking at daily and weekly just to get you a feel for what's happened since late February, early March, when we put out that first note pitching these three sectors and what we were doing about it. Also, before I go into that, I want to cover our Ask Me Anything question from Greg Stewart this week. Thank you for sending the question. It says, "Hi, Tom. I've been listening to your podcast for a couple of months now, and I can't tell you how much I appreciate your insights. I've been able to slowly transition my retirement account from primary tech stocks and defense and aerospace, and more recently, big pharma, utilities, and consumer staples. These are all ETFs, XAR, XLP, XLU, XLV. By the way, I'm looking forward to seeing these rally beneath the surface of the market during the next 6 to 9 months. I have some additional savings that I've been using to invest in individual stocks within those sectors in hopes of outperforming the ETFs in my retirement account. I've been using your earnings revisions tables to find undervalued stocks in each sector, but I've been having trouble with consumer staples. When I look at the top 30 funds in the, stocks in the XLP ETF, I see the best value in stocks like Walmart, Procter & Gamble, Costco, but you often refer to stocks like Kellogg, Campbell's, and General Mills. Also, I don't see the stocks I'm looking at in FinViz charts you are showing. My question is, what industry within consumer staples are you focused on? Packaged foods, ? Okay, so that's a good point. Number one is, before doing anything with a retirement account, you should talk to a financial advisor. That's number one. The people on the trading service, we always say this should just, be your trading money, and think of it in that way, because you're not doing it 24 hours a day, 7 days a week. And, you should be prudent, and you should be in safe stuff first. And then you have your play money where you can try to outperform. And I think that's what he's trying to do here. As far as Procter & Gamble and Costco, I like both of them. I think Walmart as well. I think you're on the right track here, George. I'm just focused on, in staples, I would say, yes, I have skewed a bit towards packaged goods, which is counterintuitive because everyone's like, well, weren't people eating snacks and soup and salad last year? But they've come in so much on the basis of the rate rise that, earnings have basically been flat. Their price in some cases have come in 20+%. And the dividend yield has become very attractive relative to the 10 years. So I'm effectively playing it in the context of rates and relative yield. As a matter of fact, speaking of that, the Domino over at CNBC was actually doing a segment today. It's interesting. I wonder, I think there are quite a lot of people that actually listen to this podcast and videocast, because I see so many. Anyway, so nonetheless, he did a great chart on the dividend yield of the healthcare sector relative to the relative attractiveness relative to the S&P 500. And this divergence is very, very rare. Usually it lags the S&P, most of the time it lags the S&P 500, but when it starts to lead, then the stocks themselves play catch up, and that hence may create the opportunity for the healthcare sector. And these yields are low. The big pharma stocks that I'm talking about, healthcare includes insurers, et cetera. The big pharma stocks I'm talking about are yielding 3.5 to 4.5%. So that relative spread is even more material, and I think has greater opportunity. Especially, you have to consider the amount of people who haven't been to their doctors in the last 12 months because they're fears of COVID. They're going to get back on their drugs. They're going to get jobs, get insurance, etc. So that's going to be. So I guess the point is, once people have nothing to worry about with COVID, they get to worry about everything else and start taking their pills for, no one cares about a little bit of high blood pressure when you're worried about dying from COVID. But, once everyone's vaccinated, they're going to be like, oh, my blood pressure's up 10 points. I got to watch out for heart disease. And they'll get back on their statins and all that stuff. So, all right. Don't mean to make light out of it, but some things, if you don't laugh about it, you'll cry about it. So often better to go for the humor. Okay, so these are the daily charts of a bunch of utilities, large cap utilities, and as you can see, we put out the article at the end of February, and these things are just ripping. They're all up 5, 10, 15% in the last 2 weeks. Huge, massive moves. And that's really good news. And if you look at them, it's like, oh my goodness, are they going to roll over here? And my guess is, after you have a move this big, like our, let's see, where is, okay, let's see what's on page 2. So after you have moves like these, Dominion and AEP, where's AEP? Right here. So these are closer to 14, 15% in 2 weeks, 3 weeks. A lot of people start to chase up now. And although I still don't hear a lot of people talking about utilities on TV, which is kind of interesting, they'll chase up. And that's when you get that, 5% pullback down to here to just take out all the late sisters and the weak sisters and late money. And then you can resume the uptrend. But if you look at the daily, it's like, oh, I missed it. And you probably did miss the short-term move, but let's take a look at longer term. These things have been subdued for the last year, and I think that's going to be a huge opportunity here. These things are just getting started. Literally just getting started. This is a weekly chart I'm showing you now. AEP, huge move, 14, 15% or whatever it is. It's just getting started. It's still down 20% from its pre-COVID highs. Earnings are doing nicely. Demand is going to go up. Demand for yield is going up once these rates slow down. This is just an exciting group to get exposure. And what's great is on the flip side, you get free protection. So if you get volatility in the stock market, managers hide out in utilities, staples, and healthcare. So you get 2 bites of the apple. You get paid to wait. You get a laggard sector. You get increasing demand. You get it's just amazing. But wait, there's more. No, I'm kidding. All right, so that's utilities. We covered that. Now this is the bullish percent staples. Remember we covered percentage, point and figure, whatever it is on a buy signal. Bottom line is it close to the bottom or close to the top? And the point is that this is generally a decent area. Obviously, you have exceptions like last year, but those are the exceptions, not the rule. You get down in this area below 50, you can start looking on a selective basis. And that's what's happened. And to George's great question, by the way, if you're on the email list, you just go to hedgefundtips.com, join the email list, and you can just reply to any of those with your Ask Me Anything questions at the end of the week. Okay, so here are our staples. We have been somewhat focused on packaged goods, but the ones that he pointed out, Procter & Gamble, Clorox is another one that's perfectly fine. What else? He has Costco here. I think Costco, we did in the trade service. That bounced a lot. But Clorox is one that people think that no one's going to use any wipes anymore. Colgate, people got to brush their teeth. So different. It's not exclusive to foods, but I would say consumer products is where the focus is, because those have gotten beaten down the most on fears that the demand was pulled forward. I don't think that's the case. But again, we put this out the last week of February and repeated that we were aggressive the first week of March, and these things have just ripped. So on a daily chart, it looks like you missed it. When you look at the weekly chart, you can see like something like Kellogg. These things are just getting started. General Mills just getting started. Campbell's Soup just getting started. And soup. The number one thing Campbell's could do to improve their business is just change the name of the company. If you look at their product portfolio, they have unbelievable snack products, chips. Like they're like Pepsi Part 2. Go look at their portfolio. When they were owned by Diamond Foods, I remember the brand Kettle Chips and all these different things. All they have to do is change their name to Campbell Foods from Campbell Soup, and the stock is probably going to go up 30%. I mean, that's just common sense what they do. People just don't understand the businesses that they're in. And it's really Pepsi Part 2 minus the soda. And everyone knows Pepsi relative to Coke, Pepsi's advantage is the snacks. And Campbell has them in spades. And if you look at some of these, you think that just have cereal or just have soup, you're going to look at a broad spectrum of snacking stuff, and they're going to continue to be in demand. And again, they have huge yields relative to the 10-year now stabilizing. They've come down materially because of rates, and they're going to rise on the same basis, and steady earnings and everything else that's working to their advantage. Big Pharma, it was interesting that we started pounding the table on this again end of February, early March. Last weekend, we were very fortunate to see a beautiful article by Andrew Barry, front page. It was the lead article for Barron's last week, talking about that's where there is to find value. And he named basically all the stocks, Pfizer, Merck, we also like Novartis. And he talks about the relative multiples, 13 times versus 22 times, and basically the exact same story. And he covers a couple other names that we haven't covered, but the thesis is right there. And I thought that was so. Opinion follows trend. When these things start to move, you're going to see more and more articles. By the way, the week before that, the front page was the second week of March. The front page was utilities. So. I think word's getting around, and that's a good thing. And by the way, if you're getting value from this podcast and VideoCast, the greatest compliment you could pay me is just tell your friends. If you can share this and it can be helpful for people, that's a good thing. All right, healthcare, again, same thing, the bullish percent. It's down at these levels. It's a time to buy, not a time to sell. And we're focused, obviously, on big pharma. And as you can see, this has basically been the laggard group. Utilities has moved first. Staples are starting to move second, and now utility, the big pharmas are just getting a bid. Like Pfizer here is up a couple of bucks. AstraZeneca, GlaxoSmithKline had a nice move. Novartis is just starting to go. Gilead's getting a little bit of bid. That's big biotech, but it's in this group. Merck is up a few bucks, but again, on a daily chart they're struggling. If you look on a weekly, it's like these things have so much opportunity ahead of them. And look at Glaxo just getting started. Gilead is cheap. AstraZeneca is just turning. Pfizer is just getting going. By the way, you may have caught Merck. It's just getting started, even though it looks huge on the daily chart. Where's Merck? It looks like a big move. It's nothing. It's just getting started. And you get paid the dividend, and they'll increase the dividend, and demand's going to go up, and. So Pfizer did a call with analysts. It got out in like the New York Post and a bunch of other things. But the basic premise was they're like, well, if you think things are good with the vaccine at $30 a pop to the government, wait until we get the whole world vaccinated. We get to, we're going to be able to increase the price to $170 a shot. And we think that it can be an annual thing. And we think that there could be a third booster this year. So, that's the bad news if you're a human being and you're listening to that. That's like, oh, is this ever going to end? The good news is if you're a shareholder, you're like, wow, that's quite a franchise that they've got. And once everyone's vaccinated and they've saved the world, they get to get paid for the actual value it delivers, and it's significantly greater than $30 a pop. So I want to, I'm sad to be on the one side of that trade as a potential consumer. Happy to be on the other side of the trade as an owner, and that's if you can't beat them, join them, I guess is the message of Pfizer. Okay. We're moving into defense and aerospace stocks now. Some of the groups that we were our big pound the tables last year. We had talked about defense and aerospace that were undervalued for a number of reasons, but one of we anticipated geopolitical tensions would start to pick up. That would not necessarily be like, we're having bad talks with North Korea or China or Russia, therefore we're going to order 100 more fighter jets. But it draws attention to the sector when that type of stuff flares up. And when you draw attention to the sector that's dramatically undervalued, in some cases paying a nice dividend to wait, trading at a discount to the S&P 500 with equal or greater growth in some instances, that's when sentiment changes and then price goes up and then everyone gets interested, and then you see an article on the front page of Barron's and then everyone gets involved. So that's kind of been the theme for the last. That's just how it goes. So here, I thought this was kind of funny. U.S.-Russia relations plunge as Vladimir Putin responds to Joe Biden's killer comments. I guess Joe Biden said that Vladimir Putin is a killer, and Vladimir Putin replied back, "It takes one to know one." So that's usually not how you start a relationship that's going to go well. And historically, not having a good relationship with Russia has usually been a good thing for the defense sector and been a bad thing for the world. So that's how it's starting. I've found in relationships, usually how you start out is how you end up. But, there's always room for change and hope. But this is not a good way to start. As such, here are the daily charts of the defense and aerospace large caps. They've made beautiful moves in the last 2 months. The group is going up fantastic. If you look at these daily charts, it looks like the move's already done. They've had huge moves off the bottom. And by the way, two that we covered in the last couple of weeks that were lagging, Lockheed Martin and Northrop Grumman, which I believe one person sent in the Ask Me Anything questions, which we gave the thumbs up on. These have had nice moves. So in the dailies, it's like, oh man, did I miss it? And then in the weeklies, you can see like, no, you look at Raytheon, this thing's just getting started. L3 Harris, Northrop is just getting started. Lockheed Martin, Boeing, General Dynamics. So my guess is after daily moves like this, you get a lot of chasers up here. That's when they gotta pound the stuffing out of those guys and gals and take it back 5 or 10%, knock out the late money, and then resume the uptrend and make new highs. But it's nice to see, and there's tremendous opportunity. So you see the market up 81%. You're like, I missed everything. No, there's still great opportunity, and we've been spending now 48 minutes covering it. So I hope you're finding it helpful. Energy, okay, that was our big pound the table mid-year last year, and if you look at the daily charts again, so they're taking the stuffing out of the people that got euphoric at the beginning of the month. If you recall, we said these are probably due for a breather. They're getting that breather, or at least they got the breather. We don't know which. So on the dailies, it's like, did I miss it, or is it going to crash now? Because you see a few red bars. If you look back at the weekly, you can see most of these are just getting started. You look at the Oxys, Continentals, Petrobras, Energy Transfer. Some of these midstream companies have just been languishing. Again, these have a high yield, and yes, this administration is going to be more restrictive. But if you look back, by the way, the biggest oil depressions have been under Republicans, and the biggest oil bull markets have been under Democrats. I mean, there are exceptions to that, but I mean, if you look at how oil performed under Obama, it was unbelievable from 2009 to 2014, his first term. Certainly, Bush was in the middle of a crash his first term, but by 2003, 2004, I mean, they just took off from 2003 to 2008. So that was a Republican, but his first term they were crashing. Under Clinton, oil did okay in the mid to late 90s. It crashed at the turn of the century when Bush came in. And then in the 80s, you had Reagan, and oil was pretty subdued. Why? Because regulation comes off. You can drill anywhere you want, and that keeps prices down. Once they start restricting drilling and putting in regulation and controlling supply, the price goes up, and the survivors mint money. And power is usually ceded to OPEC, and they get to name their price. And now that we're starting off on a really tough footing with Saudi Arabia, with the Khashoggi, and with Russia on the killer quotes, I think that those two are going to be inclined to charge us whatever price they want, because within the next year and a half, based on no drilling on federal lands, we're going to have to start importing oil from the Middle East again, and they're going to be very happy to supply it at whatever price they name. So anyway, the point is, these guys are just getting started. They'll probably take a breather again. You have the Suncors, some of the refiners, Phillips, Midstream, Kinder Morgan. We've talked about all of these, and some need to take a breather. But many are just getting started. Royal Dutch Shell, BP. I mean, these things have room. But again, they've already had huge runs, so this is not where we're pounding the table. This is where we're holding, not where we're adding a lot of new money. Unless we get a meaningful pullback, then we'll add more. But with such low bases, these we're just holding for the secular trend over the next 1 to 3 years, and that's that. Banks, here's the daily. Again, monster moves in the short term. It looks like, oh, did I miss everything? Yeah, I think in the short term you did. There's a lot of euphoria on TV. Everyone wants banks now. That's when I think they're going to just hand back 5 or 10%, knock the stuffing out of the late money and the euphoric people buying late, and buying when everyone wants it versus when no one wanted it, when we were pounding the table on it. And I think that if you look back to the weekly charts here on banks, some of these have had big moves, but I think on a secular basis, there are great opportunities. Wells Fargo, we think, has a lot more to go over the next 1 to 3 years. And for those who think that, they're toast because of the PayPals and the Squares of the world, Charlie Scharf knows payments better than both of those guys combined. And if you think he's not going to apply that on Wells Fargo, I think, you may be missing an opportunity here. I mean, look, it's up, whatever it's up, almost 90, 100% off the lows. I think it's got a lot more to go. And I think, they've got $10 billion of cost to come out of it. The yield curve is now steep. That'll probably level off, but still it's steep enough that they can make money. And they'll get payments right, and the demand from housing formation and C&I loans, which PayPal's not doing. And SoFi is not doing. All of that stuff is going to come back in spades, and they're going to be a major beneficiary for sure. So that's that. All right, moving right along. The March Bank of America Global Fund Manager Survey, obviously key takeaways, everyone's now euphoric. Everyone, lowest overweight for tech sector since managers are dumping tech stocks at the fastest pace in 15 years. That tells me there's probably a lot of tech stocks that are potentially due for a bounce, like we covered. Exposure to commodities now sits at an all-time high. If you remember, 4 or 5 months ago, you couldn't give them away. My sense is they got to take the stuffing out of that late money and have a nice 5 to 10% plus pullback, and then it can resume its early cycle trend up, and I think that's going to persist for the next 3 to 5 years in commodities. And most crowded trades that are still long tech is the sentiment, long Bitcoin, long ESG, and long global cyclicals. So the consensus is for many of these people, I have too much tech. Now, Marco Kolonovic, who I talk about sometimes, he's the quant at JP Morgan. I think he just got promoted to chief strategist. He was on, and he made a very important point. And it's in line with what I'm saying about the time to sell bonds is not after you have a 25% correction. His point is that coming into the quarter end, you're probably going to see some rebalancing. So what that means is that equities have moved up a lot, bonds have moved down. You rebalance to the initial percentages. That means you got to add bonds to rebalance. You've got to sell some equities. But that's the number one rebalance that he sees. But number two, he sees a rebalance in momentum in that he thinks that there's so much quantitative money that is momentum chasing money, i.e., it buys strength and sells weakness versus the other way around. That now all of these energy and bank stocks, according to their formulas, are now momentum stocks. And they're going to have to add more of them because they've gone up so much, which, I was talking to my wife and I said, I have an idea. Why don't we go around the neighborhood and see which property has appreciated the most in the last 2 years and buy the one that has appreciated the most that the seller paid the least. So let's say you're looking at a $2 million house that was $1 million 3 years ago. Does that, is that the type of house that you want to buy, or would you rather buy a house that's, $1 million that was $1.3 million last year? So in other words, if you were buying in 2011 and 2012 when, for 1.7, when it sold for 3 million in 2007, that's exciting to me. If I see a house like, I think I shared on this that a few months ago, or I guess it was December or something like that, I bid on a house in Palm Beach. It was through a foreclosure auction, and I got outbid by like $400,000. And for me, it's not exciting to pay for something that 2 years. So someone else made like a 50% profit in 2 years. So for me, that's just a market I don't want to be involved in. And it's the same way that I look at stocks. I don't want to buy things that have a lot of the appreciation has happened. I want to buy things when no one wants them and then wait for them to double and triple over time. Again, some people do that. They are breakout buyers. But if I think about it in terms of a house, the last thing you want to do is buy a house that just doubled in the last 2 years and think it's going to double in the next 2 years. It's just someone else already made all the meat out of the trade is basically what I'm trying to say. But what Marco is saying is there's so much money that's programmed to that now they're going to be buying energy stocks and bank stocks this year like they were buying tech last year. Tech was the momentum of last year, so all their programs just kept buying strength, and that's what created the overshoots. And he thinks that money now has to rebalance into banks and energy because they've become the new momentum. We'll see if that second rebalance is true, but the first one certainly makes a lot of sense, that the natural rebalancing of pensions, of everything else, if they've gone underweight their investment policy statements. I sit on a pension commission. We do this automatically every quarter, so this is very, very common for pensions to add to what's been weak and to lighten up on what's been heavy if it's outside the percentage bands that you've set in your initial IPS allocation. Okay. The other thing that was interesting, this was the first month that COVID was not the number one fear for the biggest tail risks among institutional managers. The highest fear is now inflation, followed by a tantrum in the bond market, and COVID is down to number 3. And higher taxes is starting to come in. We'll start to hear more about that in coming weeks and months for sure. And that was basically it. So on to the article of the week. We've covered a lot of it, but I want to go through it. This was the Steve Miller Fly Like an Eagle. That was the sentiment going into when I wrote the article on Wednesday night. And what we saw in the meeting. For those of you who are on the podcast, we're going to get cut off in a minute. So you just go to hedgefundtips.com and click on the VideoCast. It should be the first post. If not, you can just click here on Weekly Recap. and then fast forward the YouTube video to minute 60, and you'll be able to pick up the last few minutes. You'll also be able to rewind it to where we were showing all the charts so you can visualize what we were talking. We did a lot of visual this week, and I think it's important at this juncture with how everything's set up. And if you enjoyed it, please share it with your friends. Okay, moving on. So what we saw in Chair Powell's press conference this week is that he has an undying commitment to full employment, ensuring that there's no structural long-term employment like we had following the great financial crisis post-2009. Many people in their 50s got left out and they've never returned into the workforce. And he's doing anything and everything to avoid that situation. And how he'll do that is keep short rates low and keep the bond purchases going until... as they said, quote, the committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. With inflation running persistently below this longer run goal, the committee will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time and longer term inflation expectations remain well anchored at 2%. The committee expects to maintain an accommodative stance of monetary policy until these outcomes are achieved. So he starts with maximum employment, and that's embedded in their assumptions. The three numbers that really stood out from their policy statement were, first, they took their GDP projections for 2021 up to the street consensus. They had been at 4.2% in December. Now they're up to 6.5%. I'm seeing some people at 7 to 9, which we talked about last week. But the point is they're acknowledging the growth is coming. They also have an interesting thing. They took their unemployment rate expectations. I think we're at 6.3. They expect to be at 4.5 by the end of the year, which would just be amazing. But they've actually, for the first time, acknowledged inflation. They took their projections for PCE inflation from 1.8 in December. Now it's up to 2.4 for this year, albeit they do see it coming down to 2.0 and 2.1 in 2022 and 23 respective. The market wasn't buying that. That's why you saw bond yields kind of accelerate after the meeting, and then they finally stabilized after a day. But I think what's going to happen is his hand's going to be forced. And that's what I'm talking about with this 5-year inflation break-evens. This is the highest level since 2011. If you remember at the beginning of this VideoCast, I said on April 29th, 2011, inflation break-evens hit 245. They hit 258 this week. So what happened is they started jawboning from that moment about their ability to buy on the long end of the curve. And immediately what happened was this is when the break-evens hit 245, April 29, 2011. And you see, yields had spiked up coming into that, right? Just like right now, yields have spiked up. And so this is when the inflation break-evens blew out right here. This is what was happening to yields, similar to what's happening now. Inflation break-evens are blowing out. So what does that mean? The latest value implies what market participants expect inflation to be in the next 5 years on average. So right now that's 258. That's much higher than the Fed is anticipating. So when that happened, you started to see jawboning among Fed members of things they could do to buy the longer end of the curve, and people started to talk about Operation Twist, which was originally run in the 60s. And sure enough, what happened was yields collapsed, bonds rallied, and that was before they actually implemented Operation Twist, which began on September 21st. And guess what? The irony is, when they jawboned it, the affected outcome happened. Yields collapsed and bonds rallied. And when they actually implemented it, that was actually the bottom in yields and the top in bonds. So we could see a situation, if we get any inflation data that is whiffing of undesirable outcomes in coming weeks, that the market will start to anticipate that the jawboning's coming and we'll see yields start to roll over. I don't anticipate a collapse in yields like this, but I'm telling you the setup is interesting because you had such a dramatic spike, you had such a dramatic move in inflation break-evens. It's the exact same thing here I think you could see a similar type of result, and that's why, while most people think yields are going to just blow past 2%, I think he's going to blink. I think the market's going to force his hand before 2%, and they're going to start jawboning an operation twist or yield curve control. Whether they do it or not is immaterial, because as you can see here, it had the desired effect before they even implemented it. So we'll see. But he says he's data dependent, so we just have to watch the inflation data, and if we get hot numbers, just expect that things are gonna change. So that's part of the assumption for why I think that the rate of change will continue to slow. If not, the absolute rate will flatten, if not come in a bit. And that will be enough to get the groups going or continue to go that we're talking about here in the intermediate term. In the short term, they've moved a lot, so we'll probably get a breather and then move again. Okay, so that's basically that. We went over the commercials buying bonds. That's, you want to be a buyer when they're a buyer. You want to be a seller when all hedge funds. You want to be when hedge funds finally get super long bonds. That's when you want to start to sell bonds. Not when they're all on one side of the boat short bonds. They're usually, that's when you get an inflection and a reversion. The other thing that was interesting is 4 members see rate rises as a possibility in 2022. That's more than anticipated. 7 see it in 2023, and he made a new promise: no rate rises till 2024. That seems a little bit unrealistic with the way what break-evens are telling us. So they're going to have to manage that, and I think how they're going to do it is trial ballooning Operation Twist as inflation data comes in a bit hotter than expected. Now they'll try to say it's transitory, but we have all they have to say is we believe this inflation is transitory. We're not worried about it, and we have tools like an Operation Twist, like a yield curve control. If we need to, we can act quickly. We have unlimited firepower, and it's not something we need to do immediately, but we have our eye on it. If the market has a sense that he's in control of the situation and not just ignoring what could potentially be a problem, then the market will immediately behave itself. But if he keeps saying there's no inflation and any inflation that comes is only going to be transient, and the numbers keep getting worse and he keeps ignoring it, then the market's going to lose confidence and the bond vigilantes are going to scare the living daylights out of him, and then they'll be forced to react versus preempt, which they were effective in doing in 2011. So we covered that, and we covered so the 3 key takeaways from the Global Fund Manager Survey that we've just covered. 43% of managers said that a 10-year yield of 2% could spark a 10% correction in the S&P. My commentary was this probably means it'll take longer to get to 2% than most people are anticipating. I think the Fed will act before we get there too quickly. With jawboning. 2, managers are dumping tech stocks at the fastest pace in 15 years. My commentary, this probably means some parts of tech are due for a bounce. And 3, exposure to commodities now sits at an all-time high. And my commentary, this probably means big movers in the space are due for a short-term rest after being up 75 to 100% plus in a matter of months. The sentiment this week, the retail sentiment was still extreme exuberance. That's persisted. So, the market's probably looking for, a reason to wipe the smile off a lot of faces. We'll see how that plays out. It's certainly done so because the stocks that have been pounded the most are the high multiple tech stocks in recent weeks. Some of them are down 30, 40, 50%. So that's that. The fear and greed came in mid-level. This is a neutral reading. And the National Association of Active Investment Managers, that actually was down to 48% on Wednesday. Let me just see what it is now, because this often clicks right after I do the article. So they were underweight, and yeah, they started to chase up. So now, so they were underweight at the bottom, and then the market rallied, and now they're chasing up, and it's at 78%. They'll probably keep chasing. So there might be some gas in this tank, and that might be related to what Marco's talking about on the dual rebalancing. Okay, so our message for the week, we built up selective positions in utilities, consumer staples, and big pharma since we first mentioned it at the end of last month. We think the rebound in this group should continue in coming months, even if we have a few fits and starts after a nice jump in the past 2 weeks. All I'm saying is when you get these 10 and 15% moves in such a short period of time, it's nice, but a lot of people jump on it, and the market just has a tendency to just take the jump oners and take them out to the woodshed. So maybe we get a pullback and we'll have an opportunity to add a bit in those three groups. We'll see. We continue to hold our banks, energy, and defense and aerospace from much lower levels last year and would not be surprised if they take a breather before resuming their uptrend. Reminder, pay less attention to the general indices as there are many crosswinds at present and more intention to take advantage of rallies under the surface through sector rotation. So that's been a common theme and that's worked quite well. This was the data point for why the healthcare sector, not gold, is the best inflation hedge. It's the best inflation hedge sector. The data was run back to 1926 by Mark Hulbert using the Ken French data from Dartmouth, and he explains all the reasons why, so you can Google that on MarketWatch. Some unusual activity in American Electric Power. That's a utility we love. 3,000 contracts for the January 90 calls. Pfizer, 3,000 contracts for the July 32 calls. And then earnings estimates continue to tick up a little bit for 2021, 175.74, and maybe a few pennies for 2022 at 201.97, but they're still creeping up, which is a good thing. And then the economic data for this week has been pretty good. I would say the rig count actually jumped up a little bit, so keeping an eye on that. That'll help the servicers, by the way. Something to keep in mind, they've been a laggard. Natural gas draw was less than expected. The Philly Fed manufacturing blew the doors off. A lot of that was actually based on price, so there's some embedded inflation in there we have to keep our eyes on, and that's the type of thing that I think will cause the Fed to, some of the members to come out and, have these headlines come out where they say we have tools, and then the market the yields start to compress. Initial jobless claims missed. Continuing jobless claims also missed. So got to keep an eye on that. That's another reason that there's a benefit to the three groups we're focused on right now: staples, utilities, and pharma, because they're also defensive if these numbers get a little bit choppy in the short term. Crude inventories was a build of 2.3, but that was better than expected of 2.9. So keep an eye on that. Building permits missed. Some of this was weather related. Obviously, in February and early March we had some weather, but again, you got to keep an eye on it because a few months ago all of these were beats. So keeping an eye. Capacity utilization was a miss. Keep an eye on that. Retail sales were not good, -3% versus -0.5. So again, it's not the only reason we're in these defensives. It's not the primary reason, but I'm glad we are. I'm glad that the setup is there, that numbers like this will help those groups benefit as well. We'll see if they persist like this. But the pent-up demand will come out as more vaccinations get out. 100 million vaccinations already hit. That's a great thing. And then the New York Empire State Manufacturing beat expectations at 17.4. So there's some good stuff mixed in there. I would say on balance mixed this week, so keeping an eye on it. With that said, I want to thank everyone for listening in. If you found it valuable, tell your friends. We'll be back next week, same time, same place. Make it a great one.